Are you back in the market after a 10% SPX correction?
Yeah, our target 4,500, Tom, and as we said a few minutes ago, who would have thunk we would have gotten it so fast? So I'm pretty neutral now. I think we're going to have a very volatile but trendless market. Earnings tailwinds, valuation headwinds. That's the big change. You guys have been talking about it. The Fed has made a hawkish pivot, and the market is slowly waking up to that, especially bonds.
Let's go CFA Factor Analysis right now, Bob Dahl. What matters? Individual stock selection, sector selection? Is it about international sales? What matters in stock selection?
Yes, all the above. Look, I think you have to be positioned for companies that can produce the earnings and the cash flow and not expect valuation improvement. In fact, I think the opposite. That takes me more to value direction. I want to own financials in a rising rate environment. Energy on a pullback, I want to own that too, because the world's demand for oil is moving up and supply is somewhat curtailed.
So you're pretty much bearish in everything. I mean, yes, you've got pockets that you see value, but you pointed out that equities, even though they're outperforming bonds, should basically struggle to eke out a positive return for the year. What does that mean in terms of your advice to some of your clients? How do you arrange and deal with the fact that you might expect no returns at best this year?
So for sure, rebalance. If you've not rebalanced, your equity weighting because of the gains in the last few years is higher than your target. Bring it back to target at a minimum. That's the first thing to do. The second is to make sure your portfolio is not overly populated with these growth stocks that have done so well over the last few years until the last few months. You need to cut them back some. You have to sell out of them. And for goodness sakes, if you've been totally in the U.S., stand up, take a bow, and do a little dollar cost averaging outside the U.S. where economies are picking up.
All right, where in particular, Bob?
I think that Europe is probably not a bad place to be. I think the emerging markets still have a challenge with China's credit problems. So I would stay with developed markets.
Does that breakout in peripheral yields worry you at all, Bob, in Italy, in Greece and elsewhere?
I think it's a signal of exactly the theme. Valuation headwinds. When the supply or the amount of bonds selling at negative interest rates drops 70% in 6 weeks, that tells you there's a change afoot. We need to pay attention.
Bob, you've been around the block a few times. I just wonder, do you think these central banks can pull off what they're discussing all at the same time together?
Now you're onto it. That's a very good question. I mean, you're starting to hear at the periphery people talking about as they move interest rates up, as companies struggle with supply shortages, labor shortages, some cost pressures. Could we have a significant economic slowdown? I sure hope not. I don't think so, but we're going to debate that.